Over the last couple years, and even more so this year, we've been seeing a lot of these multi-billionaire investors either investing in or acquiring REITs, otherwise known as real estate investment trusts. Some of the biggest names in the finance world have been praising these investments as being great buying opportunities. Those praising these investments would include billionaire investor Warren Buffett, Blackrock Stephen Schwarzman, and Brookfield CEO Bruce Flatt. Another influential investor who just recently bought heavily into one former REIT in particular is former hedge fund manager of Scion Capital, Burry, who we all know for betting against the housing market in the 2000s. Over the last few years, these wealthy individuals have been buying heavily into these investments, praising them as being good picks in our current economic conditions. Today we're going to take a look at why these high-profile investors are in love with REITs and why we should all consider them for our own investing portfolios. Let's start with what exactly REITs are. Real estate investment trusts are companies that own income-producing real estate across a wide range of different property sectors. These companies have to meet a number of requirements to qualify as REITs, which include having to invest at least 75% of their total assets into real estate and having to pay out 90% of their taxable income to shareholders in the form of dividends each year. As a result, these companies pay much higher dividends than your typical dividend stock. It's not unusual to see these stocks offer yields upwards of 4% or even higher, and some of them pay monthly dividends as opposed to quarterly. REITs can choose to invest in a wide range of different property types or focus in on certain types in particular. These would include office buildings, apartments, strip malls, warehouses, hospitals, and even timberland to name a few. REITs are often described as being the easiest way of adding real estate to your investing portfolio, since you don't have to go through the hassle of buying properties, maintaining them, and then renting them out yourself. These companies are traded on public exchanges, so you can buy them just like you would with any other stock like Tesla or McDonald's, which makes them ideal for all types of stock market investors. In 2017, Warren Buffett invested $377 million into Scion Capital, which was roughly 9.8% of this REIT's total shares outstanding. Historically speaking, Warren was never a big investor in REITs, despite the asset class having been around since 1960. But there are a few reasons why he made the decision to buy into Scion Capital stock, as well as a few other REITs over the years. First off, Warren knows the role that dividends play in investing. It's estimated that over 90% of Berkshire Hathaway's holdings currently pay dividends, with some of them even offering yields of over 4%, including Ally Financial and Paramount. It's estimated that over the next 12 months, Berkshire will collect more than $6 billion alone in dividends from their holdings. Warren's definitely not shy when it comes to his love of dividends. He's been investing in dividend stocks since the beginning of his investing career, and although he doesn't invest specifically for dividends, they are an important factor into how he decides what to invest in. A stock's ability to pay out consistent dividends without much cuts shows that a company has a lot of strength in both their financial performance and their management team's ability to run a company. Warren also invests in companies that he believes are undervalued and have a good moat around them so other companies can't easily copy them. It's for these reasons why he made the decision to invest in Scion Capital, which is also one of my favorite REITs, although unfortunately it was just announced the company is being acquired and it's scheduled to be delisted. So the first lesson we can take today from the most successful investor in history is that dividends are not pointless or inefficient like some investors believe. Compounding dividends that are being reinvested count for a large portion of a stock's total return over time, and it's for this reason Warren loves dividend stocks, including real estate investment trusts. Let's now turn our attention to another high-profile investor who just recently took on a big position in a former REIT. Although he isn't a billionaire, he's still one of the most influential investors of the last couple decades, which is Burry. The Big Short investor turned heads a few months ago when he released his 13F filings, in which he disclosed he had sold a lot of his holdings and had invested in one stock in particular. Dr. Burry's made a big bet in a company called the Geo Group, which is a company that up until last year was classified as a real estate investment trust that owns and operates private for-profit prisons. It's a very controversial decision because this is a sector that's been under a lot of criticism by some people who claim that these companies are trying to seek financial benefit from increasing the incarceration rate. The Biden administration's also been trying to force the Justice Department to stop using private prisons, although as of today these companies are still flourishing despite Biden's efforts to stop them. But the effects of the current landscape have cost the company millions in potential revenue, and the Geo Group has stopped paying dividends. So a lot of people have been asking the question, why did Dr. Burry invest so much money in a private prison company that doesn't even pay dividends? Obviously, Warren Buffett most likely wouldn't be interested in holding the Geo Group for himself, so what's so appealing about investing in a former REIT that doesn't pay distributions? The truth is, Burry doesn't just hold investments in private prisons. He also holds other investments, including Charter Communications, which is a company that owns fiber and cable infrastructure, as well as farmland and agricultural real estate. So let me ask you, what do these three investment types have in common? If you haven't noticed already, they all own real assets. All three of these investments earn revenue from physical assets that have an intrinsic worth. Real assets like land, infrastructure, and commodities such as gold possess value due to being able to produce goods and services. This is different from financial assets, which represent claims against an underlying company. The risk that comes with financial assets is that they can become completely worthless. A company could go bankrupt, thus resulting in all of their shares being worth zero. A corporation could also default on their loans, which would wipe out the financial asset altogether. But with real estate and gold, these are assets that'll never be worthless. They aren't making any more, and we rely on these assets to produce other assets. Real assets also serve as a hedge against inflation. If we enter a huge recession, then we will see land and commodity values go down. But once we enter the recovery stage of the economic cycle, then these assets are most likely to recover. If you take financial assets though, if we enter a major recession, then many companies will go bankrupt. There won't be a recovery in their financial assets, some will go to zero. Although these assets don't typically experience the same amount of extreme growth that some stocks do, it again shows that real assets are valuable investments because of their intrinsic value. The second lesson we can learn from adding REITs to your portfolio is that not only does it give you cash flow, but it's also important to add real assets to your investing strategy. These assets fare better during rough economic times than many financial assets do. For example, as of today, Amazon stock is still currently down over 43% for the year. Are real estate prices down 43%? Definitely not. Are gold prices down 43%? Not even close. According to the National Association of Real Estate Investment Trusts, during periods of moderate to high inflation, REITs typically outperform the S&P 500 by a considerable amount. So in economic conditions like we're experiencing right now, REITs tend to shine a lot brighter than the market. But REITs are good to hold in all market conditions because of their dividends and their added diversification that they can add to your investing portfolio. Let's turn our attention to Stephen Schwarzman and Bruce Flatt. Schwarzman is currently the CEO of Blackstone, which is one of the largest alternative asset management companies in the world. Schwarzman himself is a multi-billionaire with an estimated net worth of $28.4 billion. Bruce Flatt is the CEO of Brookfield Asset Management, which is currently the largest Canadian alternative asset manager and one of the largest in the world. According to their website, Brookfield has over $750 billion worth of assets under management across real estate, infrastructure, renewables, and more. Bruce is also a billionaire with a net worth of roughly $4.5 billion. Both of these guys are real estate geniuses. They're among the best investors in the world when it comes to real estate, and they both have great investing track records. So what are these two guys saying about REITs? They're both seeing massive opportunities right now within this sector. In an interview with Bloomberg, Bruce Flatt stated the following. Probably the greatest discount out there between what you would see as value and price is in REITs and real estate securities. REITs that have high quality assets trade at enormous discounts to the tangible value of their assets. But Flatt isn't just all talk. His firm Brookfield has been buying massively into REITs. His company bought a massive stake in British Land, which is one of the largest REITs in the UK. This year, Flatt would later go on to buy other REITs, including Alstria and Bifimo, which are both European office REITs. Schwarzman over at Blackstone has also favored REITs for a while. This year, his firm Blackstone has acquired 4 different REITs, including American Campus Communities, which is a student housing REIT, Preferred Apartment Communities, which operates apartments, PS Business Parks, which is an office REIT, and Resource REIT, which also owns apartments. In total, Blackstone has paid tens of billions of dollars for these companies in 2022, and we can only speculate if they're going to keep investing more into REITs going into 2023. So a third lesson we can gain from these billionaire real estate investors is that many REITs in our current market conditions are currently trading at discounted prices. For the exposure you get to these pieces of real estate, the share prices of a lot of REITs are currently at a good discount compared to what you actually receive. Many REITs have great track records that are worth considering for any investor wanting diversification, cash flow, and a discounted asset class. Some REITs are even dividend aristocrats, which are stocks that have been able to provide more than 25 consecutive years of dividend growth without any cuts. To give some good examples of REITs with excellent track records would include such companies as Realty Income, ticker symbol O. With 629 consecutive monthly dividends declared and 100 consecutive quarterly increases, Realty Income is a REIT that's continued to provide consistent returns for more than 53 years. Another option would be WP Carey, which is a much younger company but has been providing consistent returns and dividend increases for nearly 25 years and counting. With so many successful investors pouring their money into publicly traded real estate companies in recent years, I'm of the opinion that everyone would be wise to look into REITs whether or not they're currently a part of your own portfolio. With a lot of financial experts pouring their money into these companies, it's definitely worth taking a look into these assets. Whether or not you decide to make REITs a small part or maybe even a significant portion of your own portfolio, we know that REITs carry a lot of benefits to them. The cash flow these REITs provide, along with their current discount and the exposure they provide the average investor to real assets, make them a great investment for anyone currently investing in stocks. But as always, be sure to perform your own research and due diligence before investing in any of these companies. If you're looking for REIT ideas, then feel free to check out some of the other videos on my channel where I discuss REITs all the time because they are my favorite alternative asset type. So with that being said, thank you all so much for watching today's video, and until next time, take care.